You actually lied to me earlier. You can time the market.
I guess if you have inside information, you sure can.
You're not in Congress.
Correct. That is so true. And I'm not allowed to get inside information, unlike Congress, which is kind of crazy, right?
Mm.
I'm helping the individual, and Congress is helping themselves.
You don't know how amazing you are. You might not see.
Welcome to the Act Out Podcast. I'm your host, Adam Thomas. Before we begin, I need you to like, to subscribe, to give a 5-star review. The best way to get this message across is to share it. So please share this with your friends, your family, and even casual acquaintances. I know it may feel a little awkward at first, but I've always been a phenomenal icebreaker. My favorite thing in the world? Constructive compliments. Please leave those in the form of a comment down below. For any complaints that you have, please send those to Proactive Wealth Strategies. And remember, Adam spelled C-R-A-I-G. Throwing my own guest under the bus. Kind of a new low. Oh well. Today's episode comes from Atlanta, Georgia. I know this is going to be shocking. So I used to be a financial advisor. And today's guest, Craig Seligman, taught me everything I didn't know about being a financial advisor. He's been with Proactive Wealth Strategies for over 20 years. I think he says it in the episode. I can't quite remember now. And Craig has forgotten more about the economy and the stock market than I would ever know. It was great having him on. We talked about a lot of things. We learned that there are a lot of different kinds of bubbles, but only one bubble that pertains to the stock market. We also talked about why you would need a financial advisor. I'll give you a hint. It's so you don't do something dumb. I probably shouldn't have spoiled it all the way, though. That was unfortunate. Yeah. Well, I had such a good time talking with Craig, and it was great because it really reminded me of the number one lesson that I was taught as a financial advisor. Buy high, sell low. I think that's it. Yeah. Roll the tape. Craig, thank you so much for joining me today, man. I really appreciate it.
You're welcome. Thanks for having me.
Yeah, man. How long have you been a financial advisor?
Well, I've been in the industry since last century, 1994. So I guess what's that?
You started when you were in utero?
No, I was 24, and now I'm 55. So 31 years I've been doing this. Yeah.
And so in the 31 years that you've been doing this, like, what's been like the biggest difference that you've seen in like maybe the investors? Well,
the biggest difference would just be technology. Depending on the age of people listening or watching this, when I first started,
all age.
Well, for the younger generation, I don't know if they've heard of like a fax machine or a phone call. But when I first started, that's all there was. There weren't computers yet, at least not the type that you could process something immediately. I think when I was a couple years in, I remember AOL kind of started, and it would take forever just to load. So when you'd make a trade or a transaction, you either had to call it in or send the paperwork for it. And so that's by far the biggest change from a technology perspective. I think the basic aspects have really remained the same as far as the investing side. And then what was the other question?
No, that was actually it.
Okay, my bad.
No. You're whenever I think I was maybe like 10 years old, and I remember logging into AOL. I had the dial-up thing. I went to like Disney.com or like whatever the Disney website was. It started to load. I went upstairs, had lunch, came back down, and it was like maybe 65% there.
Right.
It was still loading
forever.
up. No,
yes.
So it's kind of like today is so fast paced.
Yes.
Where there's an influx of news just immediately. Do you think what has been the effect of technology on investors and their mental well-being? Would you say I imagine you probably get more calls now from worried investors?
I think it's really the opposite.
Oh,
because there's so much information out there. If they're calling me, they've already looked at something else. where in the past there wasn't anything for them to look at except, the news or the newspaper. And so I got a lot more phone calls when I was younger in the business. As I've gotten older, I probably do a better job explaining stuff to clients. But more importantly, there's just so much information out there. They're coming to me when it's like, so what do I deal with all this? So that would be the change, I would say, from that perspective.
So do you think that investors are more informed now?
Well, they have to be. There's just too much noise out there not to be more informed. But they still most investors still always make the wrong decision.
Are you kidding me? I invested in CryptoZoo and I'm doing just fine, my friend.
Congratulations. I'm sure you are doing well with it. But most people that have been in that, when it had some great ups, they would keep it, then it would go down and they would get nervous and freak out.
Yeah.
And they would sell. So, the average investor loses money because they end up buying high and selling low, as opposed to buying whenever and making sure that your time frames are what they should be. So if you're going to invest in the stock market, you really need to look at a 3 to 5 year minimum for that money before you really start saying you want to take some of that money out. And as long as you're investing properly, the stock market typically has positive gains every 5 years. So, on average, every 5 years, you would have made money versus doing something like crypto, or I just read somewhere one of these real estate ventures, they're the commercial where, you can buy real estate like the professional now. I think out of 21 properties that they've bought, 4 of them have gone completely belly up, and all but one is going to lose a tremendous amount of money but the only way they can do anything, they got to keep raising money in order to keep what they do have. So it's just a real bad situation.
You and we've actually known each other quite a few years.
Long time now.
Yeah, I originally, I was going to start this by saying, Craig, I don't know the first thing about the economy or the stock market. I should start at the beginning. So I used to work with you as a financial advisor.
You did? How long? I mean, that was at least more than 10 years ago, right?
Yeah, 20, I think 11 or 12, something like that. Yeah.
You just graduated, right?
So, yeah, I graduated in 2009, pretty much in the heart of the Great Recession.
Yeah. And
first job, selling Aflac, supplemental insurance.
Nice.
Yes, I was wildly unsuccessful.
Well, that area is hard too, because Aflac is, based in Columbus, Georgia. And so, so many people in Georgia sell Aflac.
I did not do it.
Clearly you weren't one of them.
Yeah. But yeah, I think, at the time I would go in and, hey, let me tell you what your company needs, and, people were losing their insurance at that point. They were losing health insurance. They're like, dude, you can't supplement nothing, I have. And I think that was really the first time that I had seen or that I had really experienced a market downturn, and I could actually see the effects on people, where a person next door, they lose their job, and I mean, really struggle to make ends meet.
Right.
And I think it was jarring because there were classes that I was enrolled in that I probably didn't attend that, talked a lot about economic theory and oh, this is what happens in a recession. I'm like, oh, yeah. But knowing it in theory and then seeing how it actually affects people, on that fundamental level, that was really changing for me.
It's hard to see, right? Because you know people, and we live in a society where wealth is important, and they don't have wealth at the moment. And, it's hard. I've got 2 kids. I don't know what I would have done if I had lost my job. Ironically, 2009 and 2010, from a percentage standpoint, were my 2 best years in the industry. And the reason for that was clients that were getting let go from positions had 401ks that they needed to do something with. But I would say most of them, Adam, actually had a financial advisor. but none of them called when the markets were going down. We've always prided ourselves that that's really when clients need you the most.
Mm-hmm.
And, my company's name is Proactive Wealth Strategies. The proactive came after we had a few clients and we interviewed them.
So it came reactively.
Yes. But we were told that we were proactive at that time. And so that's where the proactive part of Proactive Wealth Strategies came from, is just people. We're like a therapist. I mean, a lot of what we do is.
I just had therapy beforehand, so it's
so did I.
Yeah.
Who did you see?
Kathleen. I'm actually going to see her tomorrow too. She's coming.
I don't know Kathleen.
Oh, she's phenomenal.
I know Katie.
How's Katie?
She's good. She helps me.
Is the economy the same thing as the stock market?
No, they're really not even all that close.
So
the stock market is always looking forward 6 to 12 to 18 months. The economy is basically what's going on today or yesterday. It's impossible really to know what's going to happen in the future. Although that's where the stock market's going, where the economy, like right now, I think last year, this is 2025. So 2023 and 2024, people kept saying there's going to be a recession. There's going to be a recession. And if you managed your money like that, you would have been very conservative during that time period.
Mm-hmm.
Well, 23 and 24 were really good years in the stock market. So you really can't put the two of them together. Now, the economy might be a leading indicator.
Okay.
But that would be it.
All right. So what does that mean, a leading indicator?
If you say that for the last quarter, let's say that the GDP, the gross domestic product, was negative.
Okay.
If it happens for the next quarter as well, then that's considered a recession. So you might want to maybe start getting a little bit more defensive. And so that's really what the difference would be, I think, is what you asked.
Okay. So it's more about like kind of time frame, I guess, essentially.
But again, I don't like to time the market. It's time in the market, right? So, I'm not going to make wholesale changes just because the economy's slowing down. Mm-hmm. But we will make some changes. What the stock market's for, right? It's not for an emergency fund. It's for investing. And there's always risk with investing. Some people sometimes will ask me, is being in the stock market like gambling?
Yeah.
Right? I would say it's nothing close to it. The longer you're in the stock market, the more likely you are to have success. When you're at a table gambling, the longer you're there, I would say, statistically speaking, every minute you're there, you have a much better chance of losing than winning. That's why you look at all these hotels in Vegas and all these other places. They're all beautiful.
Yes.
Right? Yeah. Because they make a lot of money.
Mm-hmm.
Where for someone with me, 3 months, 6 months, 9 months a year, it's I don't know. I mean, statistically speaking, I think 3 out of every 4 years, the markets are up.
Mm-hmm.
But if you're that one that got it in the 1 year out of 4, you're not going to be happy.
Mm-hmm.
So that's why I say, look, I need to have this. I need you to tell me 3 to 5 years. And then we're nothing like gambling.
If you're going to invest in the market, you're not thinking about an immediate return, right? Like you said 3 to 5 years.
Yes, as a minimum.
So timing seems like it'd be very difficult to time the market.
It's impossible to time the market. You've got to be right twice. You got to be right when to put money in and then when to take money out. Or when the markets are going down and you have money already in the markets, it's okay. Are we going to take money out now? Do you want me to sell? And so if I sell, let's say the market goes down another 5% or another 10%, but then it comes back 5% or 10%. And then it goes above where we sold out. Your psyche is going to say, I'm still not comfortable getting back in.
Mm-hmm.
So by the time you do get back in, you've lost a good portion of what you would have already, or what you would have made above where we sold out. And then it's really hard to make money while you're in the stock market.
Can you elaborate on that a little bit? Like how it's difficult to make money on the stock market?
Well, as long as you give yourself time, you should make money in the stock market.
Mm-hmm.
I don't know the exact numbers, but I believe I saw from like 1980 through 2024, if you had put $10,000 into the S&P 500, it would be worth a tremendous amount of money today. But if you just missed the top 10 days of the best 10 days in the stock market during that time period, your return would have been cut almost in half.
Oh, wow.
And if you missed the top 20 days, you were only around a 2% or 3% positive return, where the S&P has done a tremendous average over that time period.
So is following the stock market news daily helpful or harmful, would you say, for the average investor?
You're not talking about me, right?
No,
'Cause that's my
right.
job.
Yeah,
You're talking
exactly.
about
Yes.
like my clients are just any American, right?
Yes.
I would say it's harmful because most people aren't going to tolerate the turbulence.
Mm-hmm.
More importantly than that, whether you're, and I mean no disrespect, whether it's a podcast, whether it's news you're getting online, or the news that the TV shows, they're all there for one reason, and that's to make money, to be profitable.
And I'm kind of hoping to make a difference too.
Well, sure, right? Like I got into the business I'm in because I wanted to make a difference, but I also wanted to make a good living.
Fair enough.
So I don't think there's anything wrong in both.
Mm-hmm.
But we're people, not corporations, and they have to make a profit or they're going to go out of business. I mean, so do we, right? Or we go out of business.
And this is a vanity project, but it can't be that much of a vanity project.
But like years ago, I learned that the editor of one of the money type of magazines was the former editor at Rolling Stone. And then I actually bought a couple of the magazines, a couple months in a row, and I kept noticing the same ads. And then the ads, the companies that were in those ads, the financial companies, those were always like some of the top 10 funds or ETF. Back then, they were just mutual funds that this magazine would endorse. Like, great returns, yada, yada, yada. Then I just looked at some of the other ones that aren't in it, and they were actually better. So, it's not like they're saying these are the 10 best performance funds of all these same funds that are in the category. It's kind of like the dentist, the 4 out of 5 dentists that say you should do dentine gum. I mean, there could have been 100 of them, but they just took 5 of them and said 4 out of 5 because 4 of them said it.
Right.
Right. I mean, you just don't know what's the word? Not the placebo.
Yeah. Placebo. Right? Yeah.
I almost said placenta. I guess I did just say it. Yeah. It's not the word. I'm not trying to think of placebo, but it's that, right?
Okay. Yeah.
It's whatever that is.
Does the market always go up? You say, hey, I've got this stock. I think it's a good deal because I think it'll go here and go here. Like, what are you basing that advice on? And is there a guarantee?
To answer the guarantee, there's never any guarantee. There's really only a few guarantees in life, right? Taxes and death. And I think those are the only 2 that I can think of that I can say at the moment. But it's almost happened every single year that the stock market's had at least a 10%. I think it's up to 15% pullback. Again, not timing the market.
Right. Do you need to be rich in order to invest in the market?
No, you do not.
So let's say that I make, what is the median income in the U.S.?
I believe it's around 60-something thousand.
All right. So let's say I make $60,000 a year.
Okay.
What are some things that I could do to get into the market or to begin investing, even maybe not necessarily in the market?
Well, I would encourage anyone to start with a Roth IRA.
What is that?
It's a retirement account where you make, say, a monthly contribution, say $500 a month. The nice thing about this is the money that you put in, it grows tax deferred. And then when you take the money out, it's actually tax free. Traditional IRA, where you can deduct the amount that you put in, this one you cannot. It's going to be after tax dollars. But there's a big difference depending on your age. If you're younger, 30s, 40s, maybe even early 50s, the compounding growth that you're not having to pay the taxes on is going to save you a tremendous amount down the road versus the, say, $500 a month, so $6,000 a year, taking that deduction. Nowadays, you can really just go online. And there's a lot of online sites you can use. Again, Fidelity, Vanguard, I think Robinhood, Charles Schwab, those types of places. You can open your own account. I'm sure they're pretty easy to do. And you can just do an ACH, and where that's just an automatic withdrawal of money from your account every month. And that's an easy thing to do.
What would be the benefit of having an advisor versus why shouldn't I just go into old Charlie Schwab and do it myself?
I would say the easiest answer for me to say is we will prevent you from making the mistake. So since the majority of people buy high and sell low during COVID, during 2022, when the markets went down, a lot of people sold. People called me and said, hey, should I sell? What should I do? And I said, look, have your time frames changed from when you need this money? 100% of the time, the answer is no, it hasn't. Then don't worry about it. I know it's scary, But just don't worry about it. Things will be okay. Things always are okay. And again, it's not the short term, right? So when bad stuff happens, people get nervous. They get afraid. They remember 2008. But it didn't take a long time from 2008 if you just left your money alone where you got back to even. It might have taken about a year, maybe a little bit more or a little bit less. But in the grand scheme of things, that's not a long time. And if you needed it during that time period, you probably shouldn't have been that aggressive within the stock market anyway. So there's a lot of ways that you can, de-risk yourself even when you are in the stock market. There are other, types of investments. There's no guarantee, but based on research, based on what's going on, for instance, I think it's safe to say that there's a lot going on about artificial intelligence. So I put together an artificial intelligence portfolio. There's 17 individual stocks that make it up. 9 of them are actually technology based, but the other 8 are not. Performance standpoint, I think it's done very well.
It's like AI has a place, but it shouldn't be doing your investing advice.
I think if someone's doing it on their own, I don't think it could hurt. But when someone's hiring me,
right,
I think they want my experience.
Yeah,
and I'm not saying I'm smarter. There's no doubt that AI is going to be more intelligent than me.
Agree to disagree, sir.
Oh, thank you. However, I don't think that they're going to understand the psyche of a client. Again, performance is maybe the 4th or 5th reason why someone's going to work with me. AI is never going to be able to, well, I can't say never, but where it is today, it's not going to be able to tell you not to do something. It's not going to be able to relate to you. It's not going to be able to, know what your family's children are, what the anniversary is, and all those things. Those are the types of things that I specialize in, or I try to specialize in. So when somebody comes to me, again, I want to ask them as many questions as possible. I want to know if they're married, when's the anniversary? Where did you get married? Those types of things. So once a year, I might give them a call. Lately, I've been calling a client a day after their birthday. And I make a joke about it that, for me, one of the best days of the year is my birthday. The only thing that stinks about it is it's only one day. So I call them up and say, hey, now you get a second day of people wishing you happy birthday.
Yeah.
They've enjoyed it.
No,
and it's just another, 3 minutes. That's all it takes. That's what I mean by caring. It's not, hey, during the up years, you just talk about how great you are because of how much money you've made your client. They don't care about that. They care that they want to know that we care, that I care. And so when you pick up a phone and you make a phone call for someone that has lost their job, or maybe you don't even know they've lost their job, but just, hey, look, let's talk about your account for a few minutes. How are you feeling? It's not just me saying, hey, you had, 250,000 and now you're at 175,000. They can see that themselves. It's saying, here's where you were. Let me talk about how we're going to get back to that. And how are you? And are you okay? Right? I guess that's really the first question I'd say is, are you okay? Do you still have your job? Yes or no? If no, is there anything I can do? Are you going to need to take any of this money? Or do you have a savings account? Do you have that emergency fund set aside for something like this?
How long did it take you to kind of develop the skill to be able to talk with purpose?
It took a while. I've always been a pretty good talker, but with some sort of purpose, maybe not so. And more importantly, you've got to understand who you're talking to first and what their concerns are, what their questions are. So, I can't say it took 6 months, 3 months, 2 years. I'd say it's ongoing.
Yeah.
And you just get more comfortable in the position that you're in because you've been doing it for so long. So experience helps. So I would say time.
Experience absolutely does help. The first things that you talked about were like asking and listening.
Right.
So it seems like to be as good of a communicator as you are now with clients, one of your best qualities are that you listen and that you ask questions.
Well, so the first meeting with any client is getting to know them and them getting to know me. And I want to get to know as much about them. And the best way to learn something about somebody is ask them an open-ended question. And then they're kind of forced to start talking. For instance, why are you here? Like, it seems obvious to me, but there might be a different reason. What can I do to help? If you're going and talking to someone and they're not asking you questions in that first meeting, it's probably not the right type of person that you'd want to work with.
I want to talk about bubbles.
Okay.
But before...
The kind of bubbles you blow or like the stock market bubble?
Well, so when Camden pees now,
Yes.
like it's like, hey man, you're making bubbles. So I actually, it's none
Okay.
of those, man. No, so
Well, congratulations. I didn't know bubbles could be pee, but hey, to each their own. Is that where this monkey came from?
yes, it is.
You know what his name should be now?
Bubbles.
Bubbles.
I like that. I think
Yeah.
it will be.
Yeah. I think we finally named the monkey.
Thank you.
Bubbles. You're welcome. I'm more than just an advisor. I'm a friend.
I concur. So let's get back to the economy now, you
All right.
asshole.
Okay.
Can you explain like what a bubble is?
So you're not talking the pea kind, right?
Right, not the pea
Okay.
kind.
Because that one I could do pretty easy. I guess in any sort of bubble, a bubble's going to pop. So when something's getting bigger and bigger and bigger and bigger, eventually, whether it's housing, whether it's the stock market, whether you're eating too much on a buffet, right, you're going to pop. And so in 08, specifically 08, that's when the second Great Depression really took place.
So what are the conditions that make the bubble increase in the first place? And at what point are you like, hey, we need to watch it. This could become a bubble if we're not careful.
Usually it's greed. And with specifically, I think 08 was policies where the Fed was saying, I believe everyone should buy a house. Not everyone should buy a house. It's okay to rent. And so that brought the prices up. And now you've got all these mortgages taking place. And mortgage lenders want to make a living. And so, they're going to give you the best mortgage. Most of them, I'll say, will do the right thing. But some of them want to make more money. So they're not going to do the right thing. And that's when you're going to get one of those loans. And usually, unfortunately, it's lower income that happens to. And they get taken advantage of. And instead of getting that 3% fixed rate for 30 years, it might be 3% fixed rate for 4 years, or 5 years. And then lo and behold, 5 years later, your mortgage is going up. And usually that rate is going to increase quicker than what your income increases are. Banks were probably lending to some people that maybe they shouldn't have, but banks were also making a ton of money doing it. And when you fill out these mortgage applications, which you've done a few times, there's a million pages. And I don't know of anyone that actually reads every page.
Oh, yeah. I didn't even know there were words all
right. And so, back then you could maybe get a mortgage for 3% to start with, but 2 years later, it's going to go up 0.5% every year. And most people aren't going to realize that. And so, when people budget, they budget almost to the dollar. And now, more than likely, the biggest expense you have every month, your mortgage, is increasing. On top of that, in 08 and 09, you've now lost your job. And maybe your spouse is still working, but half your income's gone and your expenses are going up. And it's nothing that you can control. And so what a lot of people did is they just walked away from their houses, which is kind of, if you think about where we are today with housing, that's kind of crazy.
Yeah.
But they couldn't afford it. And now you can't afford housing for a different reason. There's just not enough of it.
Why is that? What's going on with the housing market?
The corporations that build houses, to build the affordable housing nowadays.
What is that? I don't even think people.
I think affordable housing is considered something less than $200,000.
Okay.
To start with, like a starter home.
Yeah.
Right? And because the pricing of lumber and all the materials that go into building a house, there's just really not a profit margin anymore for companies to build those types of houses.
What are some warning signs that there is a potential bubble? What are you looking? What are you looking at?
If we're talking specifically about the stock market,
yes.
Historically, the stock market trades at say somewhere between 20 and 23% return on those companies. Historically, it's gotten as high as I believe around 28% over the last few months. But it doesn't necessarily mean it's a bubble. It just probably means there's going to be a pullback. And I'd say in the stock market, it's a little bit different than the rest of the workforce because, you just don't know when that bubble is going to pop in the stock market. And so, when let's say it's 28%, during when the tariffs conversation started, late March, early April, I think we saw around a 20 to 25% pullback in the stock market. And so if it was at 28%, now we're really looking at close to 20 times earnings. So you at some point in time, you realize that the stock market's going to pull back up.
Mm-hmm.
I didn't know it was going to only take about 3 weeks, right? But that's not uncommon. I think historically, every year there's a 15% pullback almost every year in the stock market.
Mm-hmm.
So even if you end up the year 20-something% above, somewhere during that year, the stock market went down 15%. Now, it could have been you started at even, you had 4 great months and you're up 20%, and then it dropped 15%. So you're still up 5% for the year,
Mm-hmm.
but by the end of the year, you're back up to that 20% level. Most mortgages that have been created before 2022 are going to be low single digits. I've got clients that have mortgages at 2%. My mortgage is at 3%,
Mm-hmm.
where if I went to finance my house today, I'd probably have to pay 6.25% or 6.5%. So my monthly expense would more than double just because my rate was 3% and now it's 6% or 6.5%. So most people are staying in their houses. So if you're new to wanting to buy a house and there's not a lot of affordable housing being built, you're going to have a hard time starting at a house that's going to cost $450,000 or $600,000. And my wife and I recently started looking at houses because we might want to sell because our house has appreciated a lot, and both of our kids have moved out. They're both in school, and we were shocked at what people were asking for housing, and include that with the mortgage change. It just doesn't make financial sense for us to do that. So we're going to stay in a bigger house that we don't need because it's less expensive because our mortgage is so much less than buying a house maybe that's half the price, but isn't nearly as nice and doesn't have some of the accoutrements that we like to have.
You were talking about the interest rates, and I've seen that a lot in the news. How does the Fed lowering or raising the rate, how does that affect like individual investors or even non-investors?
Okay. So first, there's 2 types of interest rates. There's the Fed rate.
Okay.
And then there's the real rate. And I think you saw last year when Jerome Powell lowered interest rates, I think by 0.5%. Within the next 2 weeks, rates had gone back up. But on your credit cards, on your mortgage, on your financing of anything, that wouldn't be the case because the Fed sets rates for the banks. Okay. The Fed sets rates for your mortgages, right?
How much the Fed charges banks to borrow money? Is that what?
Yes.
Okay.
Yep. And then the bank will add on to that, right?
Okay.
When we got our mortgages, when I got my mortgage and we're paying 3%, the bank was in essence not having to pay anything to the Fed. So they're making at least 3%, which I know doesn't sound like a lot, but I believe that they actually were being compensated by the Fed to hold money back. So I'm sure they were making more than 3%. This administration is going to want bonds or rates to go down. And when Powell leaves, I'm sure they're going to have people that are willing to do it. Then rates will eventually go down and those bond prices will then come back up.
Why is the stock market so reactionary?
It's a good question. I would say a lot of it is incompetence. People getting too nervous and they start selling. After I've thought about it for a moment, I'd say the number one reason now is all the technology that's put into it. So first of all, it's real easy to make a trade now. Remember I told you back then, it wasn't instantaneous. I can sit at my computer, sell something, and within 3 to 5 seconds, see what pricing I got, right? And there's also now all these programs that are designed, for if the market goes down 1%, they're going to automatically people's portfolios. And I'm not talking my portfolios, right? I'm talking like institutional money and stuff like that. They're going to sell at a 1% loss. Not all, but say 2%. And if it drops another 0.5%, they're going to sell a little bit more. And so the selling creates more selling. And I would say it's more done electronically than, and when I say electronically, I don't mean me doing it electronically. It's doing it behind the scenes without people knowing that that's taking place.
The stock market and like how it continually goes up and down is so fascinating to me, especially the psychological aspect of it.
Right.
The incompetence is basically the incompetence and the technology go hand in hand. And it's like, hey, an incompetent person can make a really dumb decision really quickly.
If you got your house appraised every year.
Yeah, I do that.
And
just for the status.
I'm sure there's going to be years where it goes down in value.
Mhm.
Are you going to sell it? But that's what people do with the stock market. Except there, it's not once a year; it's every single day.
But the difference, though,
Yes.
is that there isn't a Zillow ad on the front page of the paper saying, "Today, Craig's house is worth $200,000." But whereas, on the front page, it's like Dow future slip, economy in free fall, like blah, blah.
Right. But you still hear you do hear the economy slowing,
Mhm.
or, the housing market has slowed down, and it has, because there's fewer inventory and fewer people want to sell their house. So if you're not getting people moving out of their houses, people can't move in,
Mhm.
and builders aren't going to keep building houses if no one's buying them. It's just easier to sell a stock than it is to sell a house.
Yeah.
Like I told you, we're having to have some work done in our house
Mhm.
because of a pipe. Well, you know how much of a pain it is to have all your possessions removed from your main level and upstairs,
Mhm.
right? I mean, there are movers there for the whole day.
Yeah.
It doesn't take that long to sell a stock. It's instantaneous. It's funny. Before Netflix came around, you wanted to watch a program. When that episode was over, you had to wait a week.
Mhm.
Nowadays, Netflix comes out, and if it's a 10 episode series, I never heard of the term binge watching until Netflix.
Yeah.
Right. And
Yeah.
now, I mean, I told you I'm not a big technology person, but I binge watch. I binge watch now. Right. Wait till the series is over. Like
Yeah.
if it's somewhere else
Mhm.
and it's episode by episode, I'm just going to wait till it's over so I can watch them at least within the next couple days, not all at once.
Yeah.
Technology is crazy, and it allows people that might not do something the ability to do it without even really thinking. And so I think that's one reason why the stock market people sell.
Mhm.
It's because they can, and
Yeah.
they don't ask anybody. And, most times if you're calling up, one of the companies that I had mentioned earlier, a lot of times the people that you're talking to aren't even licensed. And so they can't advise you. Maybe now's not the time.
Right.
They're just the order taker, and you call in and say, I'd like to sell. They're going to do it for you.
It seems like it would be very difficult for just an individual investor on their own to like beat the market, like essentially.
Well, you shouldn't try. If I was an
Why?
individual investor and I wasn't looking for help, I just wanted to do it on my own, I would just buy the index funds. 50%, 60% in the S&P 500.
Oh, okay.
The rest, if you want to be aggressive, in the NASDAQ.
Mhm.
And, you can probably find an ETF that's going to charge you 2 basis points, maybe 3 basis points, which is very, very little.
Mhm.
So you're going to underperform because you're paying basically 3 basis points. So if
What does that mean?
well, 100 basis points would be 1%.
Okay.
So if you're 3 basis points, you're 0.3% or 0.03% to be precise. So if the S&P returned 10% in a given year, you would have made 9.97%.
Oh, that seems a pretty sweet deal.
But you're still underperforming.
Not so much of a sweet deal.
But you have no other option,
Mhm.
right? I mean, you can either try to do it yourself, which I don't recommend, like actually stock picking,
Mhm.
right? Or even trying to find out, better ETFs. I believe Warren Buffett has said, if you want to do your own investing, just buy the S&P 500 and leave it alone. And it's really, really good advice.
I cannot remember where I read this. I think Warren Buffett essentially like put out a challenge a while back and was like, you pick your portfolio and I'll do like an index. I think he did an index of the S&P or something.
Okay.
And it was like, I think over 10 years, 5 or 10 years. At the very beginning, the person who like picked out their own portfolio did really, really well. It was like beating him, was like blowing him out of the water.
Okay.
But after I think it was a few years, Warren, his index fund ended up like beating, like whenever it's all said and done, beating him by a significant margin.
Right.
It's not for nothing, I guess.
No. And you shouldn't try. You're going to lose more times than you win. You asked earlier, how's the industry changed?
Mhm.
I would say, around the year when the internet really came up, right?
Thanks, all.
So so true. What a man. There were day traders. I mean, there still are.
Mhm.
But everyone at first, people in my industry were like freaking out. Like, people can do it on their own now. Well, it turned out that 98% of day traders lose money, 1% break even, and 1% make money.
Mm.
But that does not include the taxes that they would owe.
Somehow that 1% that makes money gets
is the ones that get all the attention,
yeah.
right? Because nobody ever wants to tell you about their losses. I can't tell you how many times people have told me the stocks that they've made a ton of money on. And I keep thinking to myself, well, then these guys should be billionaires.
Right.
Right? Or at least multi-millionaires. And they're not. So I know that they bought 5 shares of something that ballooned and all the rest of their money didn't do so well.
Mm-hmm.
But
I would have
wants to tell
invested in
about the losses.
Zeppelins. I still feel like they're going places.
Well, if you'd mean Led Zeppelin, then I would say yes. Probably the greatest band of all time.
The band is the greatest band of all time.
I mean, they're good. But they're not Zeppelin.
What made you decide to be an advisor?
Well, I was living in Phoenix, Arizona, but grew up here in Atlanta.
Yeah.
And my father got cancer. So I moved back home and spent, I think, about the last 6 months with him and didn't really know what I wanted to do. And I responded to an ad in a newspaper and it took me into the industry. And then when he passed away, my mom had very little money. Mm-hmm. My dad took out like a $250,000 life insurance policy years prior, and he borrowed $10,000 to put a down payment on a house, at their first house. Never made a payment on it, probably because he didn't think he really had to, but he didn't realize that there was interest. So of $250,000, I think my mom ended up getting like $113,000. The rest, the insurance company kept from a $10,000 loan. Mm. So I didn't want people to have the same experience that my family had. I learned something after my father passed away, and the craziest thing happened the very next morning, and the sun came up. I literally just felt shocked. Like I thought I literally thought for a moment it was the end of my world. Mm-hmm. And what I realized is, my world kept going. And, I'll tell people that want to listen, look, when someone passes away, you got to mourn, but you got to realize life's still happening. Your bills still have to get paid. You still got to do this. You still got to do that. So, fortunately, I've always been fairly optimistic in life.
Seems like you're pretty happy doing what you're doing.
I am pretty happy. I'd actually say I'm more than pretty happy. I'm very happy. Again, I'm an optimist. I've had 16 surgeries on my legs since 2009. Mm-hmm. And
you seem to be doing much better.
Great. Yeah. I'm doing great. But people have all said, during this time period for me, like, how do you keep a positive attitude? And my response is, what's my alternative? I'm either going to be positive or miserable.
All right.
And then everyone around me will be miserable. The woe is me. Fortunately for me, my psyche's not built that way.
Unfortunately for me, mine is. Oh, sorry.
Well, that's why you see a therapist more often.
Weekly, actually.
Which I really do suggest for those listening. It's always good to talk to someone that has really no interest in your group, mm-hmm. right? Beyond that.
Oh, yeah.
And
Absolutely.
So you really get to say things that you probably wouldn't say to maybe a friend or a spouse or your child, mm-hmm. or just about anybody that you care about.
No, therapy was life-changing for me. I absolutely, wholeheartedly endorse it.
Was that court mandated?
I mean, I wanted to. A judge told me I had to, but I wanted to.
Right.
So,
right.
Yeah,
totally.
I think that's the important part.
Yeah. You were voluntarily volunteered.
Yes, voluntarily volunteered. Yeah, exactly. Do you think your 15-year-old self would be proud of you?
I've actually made the comment multiple times that my 18-year-old self would kick the shit out of me.
Why is that?
Just because, when you're 18, you're invincible. And at 55 and after 16 surgeries, I feel anything but invincible. And so on a personal level, having 16 surgeries and constant pain for as long as I've had, I feel weaker, not weak, but weaker. Mm-hmm. And you know how people either fight or flight? I really can't do either. So like my wife really wants to go on a safari. And so we've talked about it. And I make the joke, look, I know why you want me to go with you. Because if there is an animal coming after us, you just have to run faster than me. And I can't run. I mean, I literally can't run. I mean, I walk I walk slowly. I can't even walk backwards and feel comfortable. But I can at least walk. So I can't complain. So, I've been very fortunate. Mm-hmm. I told you earlier about my leg. I've never had to worry about getting laid off from my job. I've never had to worry about losing my job because I've had to take time off for surgeries, mm-hmm. or ask a boss if I can have more time off. So I feel very fortunate with where I've been, where I am in my life. Every day is different, which is nice. And I get to decide to some degree how my day goes. I'd say the most of it, even when the mm-hmm. stock market goes down. Look, I know it's going to go down. So I can't get upset when it does.
Right.
Or I should be in a different industry. Right. Because I'd be on a lot more therapy. I hate this phrase, but it is what it is.
Mm-hmm.
And I know, and my clients know because of the amount of education I give.
Mm-hmm.
And along the way, you're going to have a lot of education. You're going to have a lot of conversations with me. And I'd have to assume that most of my clients like me, or at least can tolerate me.
I do, if that's any consolation.
Well, I do appreciate that. And, I'll make sure you get your birthday gift a little bit sooner.
Maybe the day before.
No. It'd have to be the day after. Well, it'd have to be before if it's sooner. So that's a good point.
Do you have the same investment philosophy for all the accounts, or is it kind of tailored to the client and what their goal is?
Well, I definitely say it's tailored to the client from what their goal is or and what their risk tolerance is. So, I've got clients that are very conservative and then clients that are very aggressive. So I can't do the same thing for both of them.
Mm-hmm.
But for my very aggressive clients, I'm going to use more individual stocks. And on my really conservative, and I think I only have 2 of them, because there's not a lot that I can do for somebody that needs that sort of protection. That might be, go look at an annuity or a savings account or something like that. If they're so concerned about the value going below what it was from day one. Everyone's going to have their own plan.
Mm-hmm.
But out of the investments that I use, I probably only use maybe 40 to 60 different stocks or ETFs and stuff like that. Again, exchange traded funds.
Yeah. How would you kind of describe, like, for the clients that are a little more aggressive? What is kind of the relationship between risk and opportunity?
Well, risk to me is just a short-term thing. So as long as, for instance, I bought a stock a couple of years ago, Palo Alto.
Mm.
It's done really well. But at the same time,
it's beautiful this time of year.
It's beautiful. But many times it's gone down.
Mm-hmm.
And for my most aggressive clients, the ones that have the ability to put more money in, even if they're a little bit less aggressive, but have the ability to add money, when something that I firmly believe in a stock or even an ETF, when something goes down, I might give them a call, say, hey, can you add another 5,000 or 50,000 or whatever it is?
Mm-hmm.
Because here's where the value was. Here's where it's at right now, but I still believe that not only is it going to get back to that, but it's going to get higher than that. And so if I know something's on sale,
mm-hmm.
I'm going to try to get my clients to take part of that.
What is a tariff?
It's a great question. I mean, I'm not 100% sure I know. I just understand that as goods are coming into this country, they're being taxed. So whether it's a 10, 15, or 20% tax, whatever those goods are coming in, the person picking it up or the business picking it up, they've got to pay that then. So far, we really haven't seen a lot of downside from it.
Mm-hmm.
Costs haven't really gone up as much as a lot of people thought they were.
Yeah.
I think it's still a little too early to know because there was the tariff and then there was the 90-day pause.
Right.
And it's only been maybe a month, maybe 6 weeks where the tariffs have really started kicking in. And it's going to take a while to get from, the shipyards to the grocery stores or to the, not even the malls anymore, but to Amazon and those types of places, right? So I think it's going to take a little bit of time and companies are trying to figure out how much of that they have to pass on to the consumer.
It's kind of up to the company, because they paid it in the first place, right?
Correct.
All right. So what's the choice? To either eat it or raise prices?
Correct.
Okay.
Lower their staff, the number of employees, right? Because the cost of the individual is the biggest cost that companies have, Fortune 5 companies have.
Mm-hmm.
So it's really easy if they say, we're going to cut 1,000 people. It's not just their annual incomes, right? It's the buildings that they need. It's the health insurance. It's the 401ks. All that goes away for that company. So they can save a lot of money. That's why typically when companies say they're going to let a lot of people go, their stock prices go up because the company actually becomes more valuable because they have less expenses. It's it's really sad.
Mm-hmm.
And from a personal level, I hate it. But for what I do for a living, it's like, okay, well, now there's an opportunity. If this was something I thought was good a month ago or 2 months ago, I like it even better because their expenses are going down.
You kind of brought up a really interesting point there where losing folks, or having to let them go actually does, better for the company stock. So you can't really look at that stock price as necessarily a great indicator of how the overall economy is doing right now, since we've got these many different people.
Company stocks go up because people are assuming that their profits are going to become larger. And there's two ways that you can do it: cut expenses or increase sales. Those are the only two ways that I know to get your company stock to go up. And so part of my job is to try to find out. It's easier for me to try to determine if someone's company's stock is going to go up by the market and not by layoffs, because I don't know about that until they're about to make those changes.
Right. You're not in Congress.
Correct. That is so true. And I'm not allowed to get inside information, unlike Congress, which is kind of crazy, right? I'm helping the individual, and Congress is helping themselves.
So I've saw like, it's like, I think Trump was announcing the 90-day like pause or whatever. And, like the market had been doing pretty poorly up until then. Yeah. But then like a couple of people somehow like had the best timing ever. So you actually lied to me earlier. You can time the market.
I guess if you have inside information, you sure can.
So if you're doing illegal stuff.
Or if you're making the policies, right?
Yeah.
Because they might not know about that specific, but they might know that sector, right? Like chips, the chip sector. I think there was going to be a big tariff, and then all of a sudden they said, no, for now, we're not going to have it. So if you knew ahead of time that tariff was going to go away, it's a great place to put some money. And so, yes, I've heard of several congressmen and women on both sides of the aisle. I mean, what do they say? The easiest way to wealth is politics. So, I mean, I guess you could do that for a living.
Yeah, man, that's just very depressing.
Yeah, and here we are sitting at a little room doing a podcast. Hey, who knew? Man. We could have been in politics. You still have a chance.
I know, yeah.
You've got that face. Not me.
Hey, man, you got the brains, though. And the charm.
People don't like brains.
That's true.
People do not like brains. And my brain only works really good with numbers. Not so much with words and people's faces and stuff.
Hopefully there's some exceptions, though.
Well, you are always an exception, Adam. And you've got to be able to communicate with all types of people.
How long did it take you to kind of develop that skill, or is that just something that came naturally to you?
Well, talking came natural.
I can tell.
But talking with purpose did not. So you really fake it till you make it?
You're not faking it now, are you?
Well, you'll tell me later.
Your mind with like numbers and like all of this is just, it's amazing to me because my brain is the exact opposite.
Right.
But it's just kind of ironic to me, though, that the biggest part of it, like probably the most important part of your job, is on that psychological aspect. It is. That you help your clients. Try to relieve some anxiety.
No, I would say avoid. Avoid.
That probably seems like good advice, except for the Act Out podcast, which you should tune into.
Yeah, guys, do it.
Craig, thank you so much for acting out with me.
No, I appreciate it, man.